What's going on out there? It's November 16th. I'm Frank Curzio, the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. It is Daniel Creech Wednesday. Lots of earnings to go over, lots of stuff. Daniel, let's start there, man. How's it going? Because it's tale of two companies in the same industry. I talked about this yesterday, but you're seeing good results in the same industry and companies reporting bad results within the same industry. Something I talked about, which you're not used to seeing in the past. But, you know, we got to start off, I guess, with Target.
Yeah.
That's the story today.
Yeah, I mean, Walmart blew it out. Last year, they reported good earnings. They beat them this year. Target was the opposite. They earned $3.03 in earnings per share last year. They reported $1.54 today, down from the consensus of $2.18, Frank. Yeah, to your point, you're betting the jockey, not the horse. Management teams are kind of rising to the top there. To go with the macro theme, you and I were talking about this. This makes sense because consumers are getting squeezed by inflation, so they're looking for value, cheaper. That's a big tailwind for Walmart versus Target, which is, you know, a higher tier, a higher quality, a higher price point. And you said it best. You're like, a lot of this is just common sense, man. Things are hard, and people are going to go where it's cheaper in value. That leads to Walmart over Target because of their grocery exposure and because consumer behavior is changing. They said in the last week of the quarter that consumer sentiment can change significantly. Mm-hmm. That's, to your point, when you have major corporations like FedEx, Targets, and all this warning, you got to take note. That just means there's rougher times ahead in markets and economies in general.
It's going to get worse, right? I mean, rates are going higher. Like I said, you have this big pile of cash that people have. It's getting smaller and smaller and smaller as costs go higher and higher and higher. And this, you're in this delusion that the Fed, they're going to pivot. They're not going to lower rates anytime soon. Even if they stop, even if they slow, even if it goes to 4.5, 4.5 the entire year next year. You don't know what that is going to do and the impact it's going to have on earnings, and you're seeing it. But Target compared to Walmart, and you mentioned something good when a lot of times this comes to common sense, where we can analyze the numbers, we can look at everything, but let's take a step back, right? Because when you look at the numbers, they're terrible. They missed by 60 cents. Earnings per share are down 50% year over year. Massive. They saw strength in food and beverage, which is huge, and it makes sense, right? Because groceries are getting much more expensive. So, you're going to go to Target, you're going to go to Walmart. But the costs were much, much higher here, which were unexpected. Margins got hurt. EBIT this earnings before interest taxes, not to get too technical here, but it's a cleaner version with margins. They're expecting 3% compared to 6%. In margins, if that was earnings, that's like missing earnings by like 70%. That's you see people when companies miss on margins. They put in basis points because usually it's so small. They don't say you miss by a percentage because you usually don't miss by a percentage. You miss, it's in basis points. To miss by 3% is insane. Or to say that that's what's going to be going forward means that they have a lot of inventory, which they do. But they said specifically on the call that in October, sales starting trending lower, got worse in November, and now they're warning, like you said, in December. So what did Walmart do differently? One is that Walmart caters to a lower end consumer, and Target's like right in the middle. I always argue like, wow, Target's just weird. They're just like right in the middle where it's not, you wouldn't call it high end, but it's like, I don't want to go to Walmart. I'd rather go to Target, just like, whatever. But their prices are definitely higher. So what's happening with Walmart where people are like, okay, I'm going to go buy my groceries there now because they're a lot cheaper. And sometimes they have quality issues in terms of, how they rank them in certain surveys or whatever, but the bottom line is they're going there, they're saving money, and when you're the cheapest on the street and everybody else is higher than you, what does that do? It gives you pricing power to raise up to those levels and still probably be cheaper for a lot of these items than Target. And that's why you're seeing it's a bigger story here, guys. And I talked about it yesterday, how you're going to see massive separation in companies within industries, which you're not used to seeing. Usually the whole sector goes up and some go up a little bit more than others. You're going to see stocks down 30%, stocks up 30%. And it's key in this market because over the next 2 to 3 years, what's your goal? Your goal is to gain market share. Walmart is gaining market share. Who are the companies that are going to gain market share? Because there's a lot of companies that are going to go under over the next year. A lot of companies are going to see sales go down tremendously. They're going to cut costs dramatically, like Target just announced, right? They're cutting costs. You don't hear that from Walmart. Walmart's like, this is what we're expanding into because things are really good, and they have exposure to gasoline and international sales. Even like that was actually very good for them in China as well. So, Sam Club membership, different memberships. So, very surprised at these numbers at Target. We've had this in our portfolio for a very, very long time and did well with it. This is like the third quarter in a row, though, Daniel, right? I mean, you lowered significantly 2 quarters in a row. There's a third quarter. You thought a lot of this was priced in. It's not priced in, but it goes to show you how you have to be very, very careful of what company you're investing in. And it's not just about, the markets are going to go up 20% or down 20%. It's companies that are going up 20%. Look at what Walmart did yesterday. Look what Target did yesterday, right? These are comparable. These are 2 companies that you mentioned in the same breath when you're talking about the industry. Lowe's and Home Depot as well. Home Depot I thought was a lot better. Lowe's is doing okay today, and we could turn to that with Lowe's, but you're seeing that separation here, and Target's pretty bad, and, again, they have a good balance sheet. They're going to be fine. I think a lot of this is priced in, but when you see Walmart's card, it just makes you want to run to Walmart, even at a much more expensive valuation.
Yeah, I mean, I'm not – it hurts. It's down 15%. If you're a long-term hoarder in Target, it's basically trading back to the lows where it was in May or June, where it warned, like you said, a couple of quarters ago. It's frustrating. It's a black eye, but, I mean, I don't think anybody's really worried about Target over the longer term. I think Target's one of those organizations where if management doesn't figure it out, they'll replace him, I think. I'm not saying his job's at risk or anything of that nature. I'm just, this is tough. They got to weed through all that. They definitely need to follow in the footsteps and get it, execution more quickly than Walmart. Lowe's, I thought, we've talked about this several times. We know that there's a lot of headwinds and things ahead for the economy, the markets in general, but that doesn't mean that all news is going to be negative. So you got some decent data out today on retail sales, but Lowe's comes out. If you read through Lowe's conference call and talking points, you don't think a recession's coming. He's not seeing consumers slow down. He's seeing strong demand still. He's seeing lumber prices and things come down. That's all very, very positive if you just take that by itself. You can't do that, but I'm just saying you're going to always see pockets where it's like, hey, this is fantastic. Look, these guys are booming. We talked about Eaton Corporation talking about
the difference is, and I'm glad you brought that up, what did Eaton CEO say in the call? What did Eaton CEO say in the call? Even though they reported record earnings, what did he say in this call?
Well, they think a recession is coming, yes.
Okay, here's what Ellison said in the call. And this is a guy that left JCPenney for dead and lied.
I knew that.
I'm going to be pissed off here because that was a stock that I believed in and believed in him. And not only did he, just bankrupt the company, but he left and then just went to Lowe's. And I don't think he's a good manager at all. But he's doing the same shit here because any company that's reporting pretty good earnings in this market and saying that they're not seeing a slowdown in customer traffic and they're not expecting it means they're not preparing and he's out of his mind. That's the biggest red flag out there. If companies are reporting right now, Eaton reported record earnings. I've seen a lot of companies report record earnings and say, look, yes, we're worried about the customer going forward. Even Walmart's CFO went on an interview in CBC and said the same thing. He said, listen, we're definitely seeing deteriorating trends. People are spending less. We're managing through this. We have pricing power here, and they do. And that's why they beat the quarter. It wasn't, and the numbers from Walmart, it wasn't that they're selling more stuff. Unit sales are down. It's that they're selling at a higher price, and they have pricing power, and they're taking market share, again, from Target. Well, Lowe's came out. You have to be careful because everyone's saying this, and this is the story in the home builders and the home industry where you're not going to see prices come down too much because there's not enough supply in the market. However, orders are being canceled like crazy. And because of that, Lowe's thinks that, hey, our do-it-yourself sector, which is 75% of their business, it's only 50% of Lowe's. So 25% is professional, which are pretty much contracts that are going out and they have to fulfill all the promises and the bills that they have over the next couple of years. And then you're going to see, a big slowdown. But there's a big difference to me between Home Depot and Lowe's. I thought Home Depot is having more professional of their business, where Lowe's is more tied to the individual consumer, right? 75% do it yourself. And he's like, well, a lot of people can't afford houses. They're going to fix up their house. Wrong. You do not know your consumers. You do not know what's going on out there because people are struggling. You're seeing credit card. The average credit card percentage on a credit card is 19%, high since 1980. We're seeing more household debt, record debt right now, right? This number just came out yesterday from the New York Fed. People are struggling. They're cutting back tremendously. And as home prices are coming down, it might not make sense to actually fix up your home and put money into it because you might not see that value, especially with home prices expected to come down because mortgage rates are so high. So when I look at an industry that is going to be horrible next year, it was horrible as soon as rates went above 4.5%, and they're still at 6.8%. Everyone's happy because they came down a ton from 7.2 to 6.8. No one was buying a house at 4.5 and higher, even 5. It's not going to that level anytime soon because the Fed's not lowering rates. So when I see a CEO go on, and we saw it from Ford, and I wrecked them. I saw it from Chapek with Disney, and I wrecked them. Things are great. Things are great. No, they're not. Not based on your numbers when you look under. They're not great. Okay, it's okay to say, hey, you know what? We're struggling here. We're not selling EVs. We're losing money on every EV sale. Wouldn't that be nice if Ford actually said that? They won't say that. And a lot of these companies. But when it's the optimism right now, you have the chance that 80% or 90% of the surveys out there, I think there was a Evercore survey and a ton of them, believe we're going to be in a recession next year. So you could temper expectations. For Ellison to come on Lowe's and say, we're fine, we're not seeing a slowdown. We heard that from Target 9 months ago and Walmart, and both of them fell by its largest one-day percentages since 87 market crash. You have to be very, very careful here because it's falling off a cliff. It's happening quick based on the pace of rate hikes. We've never seen rate hikes this fast in the Fed era, history of the Fed era. And they're going to result in the first sector that gets hit. Obviously, the most interest rate sensitive is housing. Now look at the autos. Now look at the semis getting nailed. And you've seen a little bit of a bid here and money, seasonal money coming in and buybacks are open up and stuff like that. But I would be very, very careful because now the expectations are higher than they've ever been, which you don't want to see heading into next year, which is going to be horrible and recession, higher rates and everything. Demand falling off a cliff. The Fed's still removing liquidity from the market through quantitative tightening, which nobody's really talking about. They're just looking at rates. That's massive. You're taking money out of the system, the trillions and trillions that you put in the system the past 2 years. I mean, if Lowe's misses or warns, this stock's going to get hit by 20, 30%. And I think over the next 2 quarters, you're going to see that. That's why I like long-dated puts, because it might go up for the next 2 weeks. It might be better than everybody else. But if you really think that they're going to generate this type of earnings, and I see this with a lot of companies, Walmart is trading at, 24 times forward earnings, but yet those numbers were really good. Lowe's, I don't know. To tell me that you're going to see demand in this sector next year and you're not seeing a slowdown, I mean, people are cutting back. You're seeing it across the board. I'd be very careful. And that's why I love earnings season, right? You really dig in and see. And I could be wrong on this. I've been wrong before. But just, to me, I think you're going to see a big separation between Home Depot and Lowe's, just like you're seeing with Target and Walmart. And I think you're going to see that over the next 6 months, and you got a real good opportunity to buy puts on this. It's not hard. Buy 9-month year puts, and do you think they're going to really meet earnings? Do you think this is a company that could fall? Because we're seeing it even today. I mean, Micron's down a ton. You're seeing Advanced Auto Parts down a ton. I mean, these companies, when they report earnings, they're lowering expectations. Earnings estimates are way too high. It's giving you an opportunity where, okay, I don't know what the market's going to do, and I don't know how the big companies are going to do, but I know is individual names and even, industry leaders or the top 3 or 4 of those companies where, 1 or 2 of them are not getting it done and could see a significant pullback here. And that's what I'm seeing here. So for Lowe's, I wasn't too crazy about, but, we can move on to TJX. I don't know if you have any more comments on Lowe's, but TJX was pretty solid.
Yeah, I mean, they're definitely, Lowe's, I could play devil's advocate but it's just going to get you fired up. It did shock me like I said, how positive he sounded. It definitely stood out.
Oh, they reported a good quarter. He's
some
very,
of the things
positive.
He said, the average U.S. home has roughly $330,000 of equity and is 40 years old. He said people incorrectly thought millennials wouldn't own homes and be permanent renters. The opposite is actually occurring. And he says he's positive about future trends in 2023. So we'll mark this on our calendars. Like I said, it's one of those standouts, and time will tell. But yeah, he's very optimistic. So
have you owned a house?
What's that?
Have you ever owned a house?
No.
Okay, so $330,000 equity in your home is meaningless because you can't get it out. Right? You really can't get it out. I mean, how do you get it out? You used to refinance. You can't refinance now, but you know how they're getting it out? Is HELOCs. Because I had a really good guy who works within the industry. I won't tell you the company he works in. And he was like, Frank, I'm not seeing this at all, whatever. And he emailed me, and I took the question on Frankly Speaking, which is only for paid subscribers, where all you guys get to write in, and I have a Q&A every Friday. It goes directly to all those. Yeah. And all you have to do is own one product, and you get it here. But that's Frankly Speaking. But he had a really good point. He's like, we're not seeing HELOCs at all. Numbers just came out showing from the Fed that HELOCs, again, had a huge, huge quarter, which is, home equity lines of credit. They're trying to take their equity out of their homes because everything's going higher, and they're seeing their costs go higher tremendously with interest rates going higher, right? And their costs, everything. And they're not generating as much revenue. And the possibility of them getting laid off, some of these people. But when I see that equity and getting it out, you could sell your house, but it's not as easy to sell your house where, that market is coming down. You could sell it, but you're not going to sell it for the price it was 6 months ago, definitely. Not even in Florida, you will. So how do you get the equity out of your house? And that's the thing, because that's what they're looking at, going, wow, we have all this equity. Yeah, you could sell it, but, that's different. You're going to have, extra money, but you still have to buy another house. So it's going to be interesting to see how they tap that equity and how they get it out, because it's not as easy, and you're going to pay a much, much, much higher rate to take that out of your house right now. And I don't know. I don't know if that's the best thing and we'll see. But
yeah, that just surprised me. Like I said, his optimism is a standout. That's for sure.
yeah, and I just don't like optimism when you don't have to be optimistic. You just say, hey, we're seeing it pretty good and it's okay. Not like, hey, no, nothing at all. And I know his history, and yes, it's personal for me because, I think the guy is really, I won't even go into the word I was going to use, but yeah, it's, I don't like him as a manager, and that guy has always been optimistic when things aren't optimistic, and I hate that. He reminds me of Ford, it reminds me of Jay Pickett with Disney. Just tell the truth and tell you how things are going bad, because those guys just painted this picture like everything's great, the future's great, we're awesome, and they had a massive multiple and fooled a lot of people, and both those stocks have gotten hammered.
What's the term? Carnival barker?
Basically. Yeah, basically. So TJX I looked at. TJX is also a portfolio holding and recently recommended, doing good. One of the only companies I think you're going to see, maybe I'd like to see Burlington, because I don't shop at Burlington often. I just went there. My wife wanted to go there, and I must have bought, this is like probably about a few months ago. I think we just, going away for a couple of days, and we said, hey, let's go to Burlington. And we both really want to go to Burlington. And I wound up buying I think 12 pieces of clothing, and I must have paid maybe $100 for it or less than that. And these are all like big brand names. I was like, holy shit. And that's TJX as well, right? So you're seeing these inventory where apparel isn't really doing well in a lot of segments. For some reason, they have to get rid of their inventory. We all know Walmart did a great job getting rid of its inventory, high inventory in apparel, because that market's really, really coming down and has high inventory. And that inventory goes to TJ Maxx, which said that their margins went a lot higher this quarter because they're probably getting it at fire sale prices. They got to get rid of this inventory, and then they're able to sell it at a decent price and still make a profit on it. I mean, you're getting brand name shirts that could be $30, $40 for $15, dollars and $20. And, if you're getting them for $8 or $7 or whatever they get them for, I'm just putting in perspective. But TJX was good, which is, when I looked at those numbers, sales missed, but earnings were higher. Their margins were good, which shows pricing power. You need to see that with these companies, because unit sales are going to be down. People aren't buying as much as they're buying, but they're making it up on pricing, and not everyone has pricing power. Walmart has it. TJX has it. Again, one of the few companies that said apparel was doing good. Great balance sheet. $3.4 billion in cash. They're going to spend around $2.5 billion on buybacks over the next 3 to 6 months. That's about 4% of its market cap. So, if you want exposure to retail, I think TJX is great. Walmart's a little bit more expensive. But those numbers are there, and Walmart may not be as expensive if they continue to drive those earnings higher, because not only they have pricing power, they're taking market share clearly from Target and from everybody else. And let's see, even from grocery stores, especially, where, people are seeing massive increases in the price of food, and they're starting to go to Walmart and even Target, which said that grocery sales were good as well, right? Food and beverage. Mm-hmm. But what was the percentage you said between Target and Walmart, really quick, in terms of how much is grocery related?
Target had about, this is just the last quarter in the 10K, groceries, food, and beverage were about 20.5% for Target, and they were about 58% for Walmart. That's under the grocery category. And that was in U.S. net category sales for Walmart.
So that's total sales? 60% of total sales for Walmart?
In the U.S., yeah. So, it wasn't the 150 in revenue. It was like 105 and change, but they broke that down. But I was just showing you how much. That was just in the U.S.
Wow, that's incredible. Wow, that's awesome. Yeah, it's good when you have that much leverage to the category, and that category is really kicking ass, right?
Well, when you're doing 150 billion in a quarter, you got some.
No, absolutely. Absolutely. But yeah, I want to bring this up again, because yesterday I had this whole podcast where I'm trying to explain it, where I'm not contradicting myself, where, I'm not too sure where the market's going to go, but I'm seeing like companies within specific industries that are going to get it done and not going to get it done. And it was funny because we mentioned Walmart, and now we see Target. We mentioned Norwegian Cruise Lines, how all their debt is fixed. They don't have any debt payments. They focused on a higher-end consumer. And what happened last night, which you're seeing in Carnival down tremendously today, down at 12, 15%, they needed to raise money, another $1 billion in financing. And that was one of the ones, and they focused on a lower-end consumer, which are really having trouble. And you're seeing it across credit card trends. You're seeing it from the Walmart. You're seeing everybody warn about that, saying that they're definitely cutting back on spending, and they're seeing, just high gasoline prices, high prices across the board. It's hurting them. That's Carnival's bread and butter. That's where they get the most revenue from. So last quarter was weak, which I reported about 5 weeks ago. They showed that costs were up significantly, while they didn't have much pricing power to pass on those costs to the lower end consumers. But in that quarter, analysts were not expecting the company to need more capital, at least from the tone from management, right? They said it's a little weak, and so this was a surprise. $1 billion raise at 5.75 convertible senior notes due 2027. It's just when you're under the impression that the company doesn't have to raise money, and I've been through this even with mining stocks and whatever, when they're like, no, we have enough capital, and all of a sudden they do some kind of deal and they raise money like 2 months later, and you're like, you just told me you didn't need capital, right? So if you didn't need capital, well, it's good money, and then you'll bring in some guys who basically are going to blow out of your stock that don't give a shit about your long-term value of the stock once that lockup period ends, and they're raising money just for the fees. You have to be really careful here because this billion, again, bonds better than stocks. That rate doesn't seem too crazy. 5.75 convertible senior note due 2027, but it does hurt credibility when you don't think you have to raise money and companies come out. You don't have to worry about Norwegian. I mean, they don't have any money due. They have fixed line of credits, right? They restructured it, all this, during COVID. Now all the boats are in the water. They focus on higher end consumers. It's much cheaper to go on these cruises, even on the higher ends for Norwegian, than it is to go to Disney World and take your family there for trips. And, I think, again, you're going to see separation. You saw it also today, Dan, with Micron warning again, huge inventory concerns. Well, and I don't know if it's apples comparison. You could say, they're both in the same industry, but Taiwan Semi, more money coming into it. These guys have, their margins are incredibly high. They're one of the few, I think Samsung, and I don't know if Intel still has the fabs and makes chips. They do, but again, they're looking to get out of this business, back into this business, do the Biden plan. But, Micron warning again, but Taiwan Semi is a much, much better place where they have higher margins and have pricing power because they're the biggest and the best. And they're probably still, close to full capacity as their clients. They have all the biggest clients, including Apple. They're just light years above everybody else. So there's going to be separation in semiconductor companies as well. But you're seeing it. You're going to continue to see it. That's why I love, keep pushing down your throat. Buying puts as a strategy because there's a lot of companies I'm seeing that are definitely not going to meet. Earnings estimates are way too fucking high, guys. They're way, way too high. Nobody has this right. It's going to be 180. It's going to be 180. And the lowest on the street right now, the base case for Morgan Stanley is 195. The base case for Goldman is 200. Right now, they're sitting at $237 for next year's earnings. They're going to be 180 next year, which means that a lot of companies are going to do exactly what Target did today. They're going to warn and lower guidance significantly, which is not priced in. And if you get a 14, 15% decline in the stock in a day, you're going to make a fortune on these things. And if not, it's okay because there's a lot of companies that you're long that are probably, hold up well. And I think Home Depot, you look at Walmart as well. There's companies that are getting it done. Apple looks pretty good right now, right? Definitely separation from the rest of the fangs, but let's see what happens. But that's a big theme here. It's not all companies within a sector. You can't bet on sectors here. You have to bet on individual names because management teams and fundamentals guys are going to matter significantly over the next 2 to 3 years. They didn't matter over the past 12. It didn't matter if your stock was trading 150 times forward earnings, as long as they were growing. That's all anyone cared about. You got clients coming in. That's why Disney. People bought Disney damn like crazy because that's subscribers, massive subscribers. No one cared that they weren't making any money on those subscribers. Now it matters because now you're going to have to cut costs significantly while other companies like Walmart are looking to expand and build on their momentum. And they're going to be taking market share. And that's going to be a big theme, guys, going forward over the next 2 years, especially over the next 2 quarters.
Well said. I like that, Frank.
For me, I love this type of market where you have to dig into earnings. You have to dig into those fundamentals. You have to see what's going on, what segments are doing well. It's extremely important because there's 2 major themes here, Daniel, that you got to focus on. And it's pricing power. Companies have pricing power. You have Walmart that has it, and you have Target that doesn't. You see Norwegian has it. You see Carnival doesn't. And companies that are gaining market share. Because those companies are going to do fantastic. And if you have your own businesses, and listen up, guys, because this is what you want to do in these markets where you're providing a great service for your clients. How do you take market share? Yes, you're going to have to raise prices to cover your input costs, but not to the point where you're just screwing everyone and you're raising them so much more. But yes, it's going to be a slowdown going into next year, but there's going to be a lot of players that aren't going to survive, and they're going to lose a ton of business from doing the wrong thing or whatever. And it's your opportunity because we know later on the S&P 500 is going to go up a lot, right? It's going to go up a lot. Long term, 3, 4, you look at the charts as the 50s, it goes up and up and up, right, Daniel? So, it's just a period right here of maybe 24, 36 months. It's going to be really, really ugly, I think, as long as rates are high. And management teams, like I said, are going to matter. If they see you have your own business and you're going to do well with that, you have to focus on your customers right now. You have to keep those prices low. You got to worry about those cuts. But this is a time to take market share because if you have pricing power and you can take market share and treat your customers good, that's huge. because that's what Walmart is doing, right? That's what Walmart's doing with Target. They're taking that market share away. They're taking it away from grocery stores through food and stuff like that. So, and when I look at this market, who are the people that we made fun of all the time, Dan? You look at Einhorn, you look at Chanos, right? All these people that you made fun of, Carson Block. These are guys who are forensic accountants.
Citron, the one guy retired during the meme stock rallies and stuff. Not retired completely, but he said, hey, we're not short and we're not going to be public about this anymore. Remember when he tweeted that a while ago?
Yeah, that's true. So,
but to your point, great, amazing analyst.
I mean, these are guys that people making fun of because it didn't matter. It didn't matter it didn't matter. I think he was shorting Shopify or whatever and got wrecked on it. But it didn't matter as long as you were growing, just like Disney. As long as you're growing those numbers, nobody cared how much you made on those numbers, on those subscribers, right? Just grow that number, 100 million, 150 million, and your stock went higher. And that's true for social media companies as well. And all these unicorns, right? Just, hey, look how much we have 1 million users, we have 5 million users, 10 million, how much you're making. Doesn't matter. We just keep growing that user base, right? Now it matters. Fundamentals matter. You need a good balance sheet. You're going to see cost cutting. Management teams matter. This is what you have to focus on, because when I look at a company like Lowe's and a CEO like that gets on and tells you how great everything is, we saw how it could switch on a dime.
Yep.
We see it. We see it through this whole entire period. Holy cow, you just said it was great and now it's not great. Where, again, the Walmarts and the Targets fell by their largest one-day amounts since the 87 crash, and you're seeing some of these companies fall by 20%, even the Googles, even the Metas, right? So I would bet that Lowe's, with the optimism there, and these guys expecting everything to be okay with do-it-yourself market, and consumers are going to suddenly have money to spend, they're trading at a pretty high multiple. I'd be careful there. But I would bet that they're going to see, all you need is a little bit of a hiccup from those guys, because optimism's now built in, the stock's going higher, and over the next 2 quarters, 3 quarters, where the housing market is, do you think those numbers are going to be record? Because that's what they're reporting, record numbers. You think they're going to be record numbers next year where the housing market is? I don't. And if they miss, you're going to see a 20% plus decline, and that results in 100 to 300% gain depending on the put that you're buying over a whole year. But that's what you're betting on. You don't care about these markets and a 6% move in NASDAQ here and there, and you're going to see those during bear markets. But earnings are going to come down significantly, and you're going to see that, and that's the danger, and that's what I'd be worried about. So any final thoughts, Daniel?
I do like the conversation we've had about short sellers. We need to get a couple on the podcast. Those would be good interviews, and just because I think you're right that they've been made fun of, and this is going to be a perfect environment. So it's going to pay. It's going to pay attention to it.
No, absolutely. Okay, guys. So look, that's it for me. Dan, thank you so much. Questions, comments, I'm sure we get a lot these days. FrankCurzioResearch.com. Dan, what's your email?
Daniel at CurzioResearch.com.
All right, guys. Take care, and I'll see you tomorrow.